Hello, everybody. Welcome to today's webinar. I am Andy Finnegan, marketing lead here at Nebo Wealth, dialing in from our corporate offices downtown Boston. It's actually been a beautiful day here today, almost 60 degrees. We got Christmas decorations up in the office. I was able to take up some Christmas trees down from the lobby, and a little trivia when I get home tonight for dinner. I'm excited to tell my 5-year-old daughter a story that Daddy was on TV in the North Pole. At least that's the tale that I'm going to tell her. Joining me today, I have Martin Tarley, he's our product lead, and Adam Scully Power, our practice solutions director. Hey guys, how's it going?
Andy, how are you?
Doing great. So just to set the stage for our audience today, what you'll be learning, our session is beyond risk tolerance, reconnecting portfolios to financial plans, goals, time horizon. We have a mix of familiar faces on the line. Thank you for being here. And also wanted to extend special thanks to Bob Verez for sharing this session with his readers. Delighted and excited to have you joining us today. And just a quick note on the CE credits. We're fairly new to the process. I realize there hasn't been a spot to enter your CFP number when you registered. If you can send me an email afterward, I'll also personally follow up with everyone. Make sure you get the replay, the slides, written highlights, make sure your credits get submitted. So Adam, to start, for folks maybe not familiar with what we do, Nebo Wealth, why don't you just quick level set who we are, who we serve, et cetera.
Yeah, well, thank you, Andy, and welcome everyone. I'm, as we said, dialing in from our office in downtown Boston. It's looking out the window right now over the course of this webinar. I think you're going to get a phenomenal Boston sunset in the backdrop. So we start with a little bit of light, but we may be quickly darkening as the webinar rolls on. For those that may not be familiar, Nebo Wealth is a company that does goals-based portfolio construction. What powers that is some very advanced wealth optimization. In fact, Andy, that is the underlying or underpinnings of many of the awards that we've won since launching 2 years ago. You see a few on the screen here. We brought this solution to wealth managers, advisory firms a little over 2 years ago. Honored with an industry disruptor award right out the gate. We've won best goals-based investment platform for the last 2 years and a number of other awards along the way. But what we do is we empower financial advisors to deliver more personalized, more goals-based portfolios for the clients they serve. And as we'll get into today, goals-based investing is a huge thematic trend that we see in the industry. We think we can help advisors deliver that in a more robust way and ultimately improving client outcomes.
Thanks, Adam. So maybe this one's for you, Martin, that, we're out at conferences, we're talking to advisors all the time. We love asking this question. So just to interact with everyone in the audience, if you could just read the question on the screen and just think in your mind, I'm going to count to 5 Mississippi on a scale of 1 to 100. How important is asset allocation for determining client outcomes? So I'm just going to pause. Okay, Martin, so why don't you share these results that we're seeing on screen, what we've learned, and elaborate on why it's so critical to get the asset allocation decision right?
Yeah, thanks, Andy. So this question about the importance of asset allocation, we've, for the last number of years been interacting very closely with financial advisors and really getting to understand how they run their businesses and how they operate their wealth management assembly lines. And when we ask advisors about the importance of asset allocation, we get very high numbers. So the number that you're seeing here is sort of the average of, we've polled hundreds of advisors, and the average is about 90. The median is, I think, 100, because more than half of the advisors that we polled say that on a scale of 1 to 100, it's 100. So everybody agrees that asset allocation is really important, or financial advisors agree. Now, academics also agree that asset allocation is really important. And there's some widely cited studies over the years about numbers being a 90% plus in terms of importance of asset allocation. And there's some disagreement in the academic community, as there always is, about the important, but everybody agrees in the academic community that asset allocation is really important. So how does asset allocation typically tie into kind of standard portfolio construction techniques? Typically what happens in standard portfolio construction techniques is you construct an efficient frontier where you sort of maximize expected return for a given level of volatility. And that given level of volatility is what is really tied to the asset allocation. So you can see on the screen here that as you move up and to the right, the pie chart gets darker and darker blue, and that's representing more and more equity allocation into your portfolio. So there's this direct connection between the asset allocation and the volatility of the portfolio. What we believe that has led to in the advisory world is this idea that the primary determinant of a client's or an asset owner's asset allocation is often determined by a risk score. So oftentimes what will happen is a prospect or a client will come see an advisor. The advisor will do a lot of really good financial planning work. They'll then also do a risk tolerance questionnaire. That risk tolerance questionnaire will produce a risk score. And that risk score is what ends up driving the asset allocation. Now, the problem with that is if you go and you change the planning inputs, the goals, the cash flows, the legacy, charitable contributions, et cetera, that doesn't change the asset allocation. That doesn't change the portfolio. Why? Because the risk score didn't change. So we all agree that the asset allocation is incredibly important, but it's only being driven by a single input.
Thanks, Martin. That was very helpful. Now, Adam, this is for you. I just saw you speak on stage at Schwab Impact. We were there together in San Francisco, standing room only. And this slide, you can almost see in real time the audience kind of, get up in their seat a little bit. And, I love how you talk about this slide and hearing you talk about our philosophy, but also who we're not for. So maybe that's the best way to define kind of who we are and what we do. Can you share some of your thoughts here?
There's this trade-off between risk and reward. And in essence, entirely modern portfolio theory is built out of this. But the emphasis has been on downside risk. And what happens is it's sort of the proverbial how much can you lose before you lose sleep at night question that we get asked in various ways through the risk tolerance questionnaire. That's what drove, in essence, modern portfolio theory. I would argue that the advent and emergence of behavioral finance actually emphasized that even more. So the focus has always been on downside loss tolerance. And as you can see here, you take the downside number, you can map it to a volatility, and you get a stock bond mix that corresponds out of that. Excuse me. The way that we have determined that, as Martin so nicely stated, is the risk tolerance questionnaire emerges as the primary driver of asset allocation decisions. And I understand how we got here. It's quite simple. It allows advisors to quickly classify investors into broad groups like conservative, moderate, or aggressive, and then just map them to a fixed allocation and kind of a standard model portfolio. So when you think about true goals-based investing, I think your question is who's NEBA Wealth not for? If you're a risk score to Model 3 framework, again, there's nothing wrong with that, but we're probably not for you. We think we can expand upon the inputs that go in to determining a truly bespoke, personalized, goals-based, both asset allocation and portfolio solution for a client. And what I'm going to do here is I'm going to show you an example. We call this the two client problem. And I think this emphasizes the challenges of risk tolerance as the driver of asset allocation. Here we have two clients. Notice their ages are vastly different. They have slightly different retirement ages. Their incomes are incredibly different. Their savings rates are different. Their account balances are different. And the amount that they need to pull out in retirement are different. So two different clients, different goals, different time horizons, different objectives, all of that. But yet, if they happen to answer the risk tolerance questionnaire the same way and get the same corresponding, quote, risk score from that questionnaire, they often get put in the exact same portfolio. And we look at this and we say, this doesn't make sense. And the question is, what does risk tolerance questionnaires not account for? And the answer, I would argue, is everything that matters. The client's time horizon of their goals, their current and future cash flow needs, their current assets, any legacy goals they may want to account for. It's not that risk tolerance isn't incorporated into our process, but it's one of many inputs that goes into it. And where we see this manifested so strongly is we work with obviously lots and lots of advisory firms. I call it hidden in plain sight, Andy. Everyone knows it, they see it. And what we hear all the time is because clients tend to answer that risk tolerance questionnaire the same way, the quote is 90% of our clients end up in the moderate portfolio model, and we simply know that's not the right answer.
Thanks, Adam. I love that visual. I refer to it as a tale of two clients because it's a way that I could actually relate what I'm doing at work to my dad over Christmas dinner, or it just makes it so much more concrete what we do. So I've also heard you speak about risk tolerance with other challenges like behavioral biases or really how you're feeling when you wake up in the morning. I mean, if I have a 1-year-old at home, he was up at 4 a.m. last night. If someone handed me a risk tolerance assessment before I had my Starbucks iced Americano, I'd probably score pretty low and cranky on that. And that could be a problem if it's a static set it and forget it. So can you walk through the next couple slides?
Yeah, these are slides that we use to really emphasize, I think, some of the challenges of allowing risk tolerance to drive asset allocation. Again, risk tolerance in and of itself, there's nothing wrong with it. But what we tend to find happen is the responses you get to the risk tolerance questionnaire are very, very heavily influenced by things like recent market trends, by behavioral biases, short-term emotions. So, for example, right now, we've been in a sizable move up in equity markets. People have maybe forgotten a little bit about the drawdown scenarios of the COVID crisis, the financial crisis, and the like. So what I have here is I've plotted basically 20 years of portfolio data on the S&P 500. For those that were in the industry and recall, it was quite a volatile period. But if we were to give clients a risk tolerance questionnaire at sort of the peaks of the bull markets, what you tend to find is they're less concerned with downside losses. They tend to answer more favorably, if you will, thus generating a higher score. Conversely, if you ask questions how you feel about downside losses in the bottom of a bear market, they tend to be very, very, very conservative. So the challenge number one is risk tolerance questionnaires are heavily influenced by where we are in the market cycle and sort of behavioral biases. The second aspect of this that is connected is the fact that typically with a risk tolerance questionnaire, it's often given to a client. We would like to think that it's given on a regular basis, but what we hear anecdotally is that that's not actually the case. It's a little bit of one and done. So once the risk tolerance questionnaire is done, which drives the asset allocation, it tends to be a static portfolio allocation whereby you would just rebalance back to that original weight on a regular mechanical type process. Now, if you happen to take that risk tolerance questionnaire and respond, and the output of that was a very low score, let's say the bottom of a bear market type environment, and then you're simply rebalancing back to that weight, that may not be sufficient enough to actually capture your goals or the required return needed, and the like. So where in the cycle
Adam,
you take it makes a big difference.
yeah, Adam, let me just jump in for 1 second, just expand on that point about sort of the one and done from a risk tolerance questionnaire perspective. I think there's a very deep reason for that, is because the risk tolerance questionnaire is trying to get at what is considered to be a fundamental emotional component of the individual that is not supposed to change over time. So if you were to give a risk tolerance questionnaire and you were to give it periodically and you got different answers, it would be as though the fundamental psyche of the asset owner was actually changing over time. And what that would mean is that the portfolio is changing because the psyche of the individual is changing, not because their goals and objectives are changing.
Yeah, very well pointed, Martin.
Yeah, it's a great point. I was going to do a jump ball, but Martin, since you were speaking, we do a lot of advisor surveys. They're a lot of fun. We get a lot of good data from it. So any learnings, maybe I'll go to the next slide, just from the front lines again, from when we're talking about this, Martin, maybe you could walk through.
Did we lose Martin?
Am I there?
Oh, wait, there you are. We've got you, Martin.
Okay. So we talked about asking advisors about asset allocation. We also asked them about the importance of the risk tolerance questionnaires. The first question that we ask is, do you believe that standard risk tolerance questionnaires adequately capture a client's true risk preferences? This is sort of related to the point I just made. There's this notion that there is a true risk preference that each individual has. But advisors are not confident that these questionnaires are actually getting at that sort of core psychological issues. We then asked, do you think risk score should be the main determinant in a client's asset allocation? And 87% say no. So we have a conundrum. We have a situation in which everybody agrees asset allocation is really important. The risk tolerance score, the risk score, is driving that asset allocation. But advisors don't think it should be. And this is the problem, as Adam put well, that is hiding in plain sight. There's a disconnect here.
Thanks, Martin. That's really helpful. Just kind of thinking about next parts of the presentation. Adam, I hear you talk on the floor a lot when you're on calls or just when we're syncing up together about this term we call wealth optimization. And can you just walk through to the audience what it means, why it matters, et cetera?
Yeah, so this is really the key, in our opinion, to unlocking truly personalized, goals-based portfolio management. And when we talk about wealth optimization, what we are saying is we want to incorporate the unique goals, objectives of the client through their financial plan. We want to account for the forward-looking returns needed for that client over the time horizon. We want to account for the minimum wealth that they need to make that plan work. And then what we want to do is we want to optimize the portfolio around their wealth levels, as opposed to allowing just the risk tolerance score to drive the asset allocation. Now, there's a lot that goes into that. I think we're going to dig a little bit deeper into it. But when we build those portfolios, Andy, not only are we using this advanced wealth optimization framework, but we want to also incorporate current market conditions, and we want to be able to account for forward-looking market opportunities. So it embeds into that framework a forward-looking capital market assumption, so that we're taking the robustness of the underlying client circumstances and the robustness of institutional grade portfolio construction and bringing those two things together to deliver highly, I would say, hyper personalized portfolios. And at a singular level, what I would say is wealth optimization really boils down to this. The true risk for the asset owner is not having the money the dollars, the wealth that they need when they need it. And so what we are doing is we are building portfolios to minimize that risk to the asset owner, which is, again, not having what they need when they need it, or as we move into the high net worth and ultra high net worth client base, not having perhaps what they want when they want it.
Got it. Super helpful. So just for the audience checking in, we're about 20 minutes in. We're going to get to a demo, seeing a preview of our latest interface, probably in another 10 or 15 minutes or so. We have this area that I call the goals-based playground. It's a lot of fun. I believe the Q&A should be open, and I'm going to be asking some questions later on, but we're working with the team on that to make it interactive. Adam, just continuing on the spirit of wealth optimization, I'm going to, just benefits or the way of thinking about it. Maybe you can drive and just walk through this slide.
Yeah, so maybe I'll just take a second and I'll have Martin jump in, but we'll talk about what it means and why we think this is a better way to go about portfolio construction. The first is actually quite obvious, and is we directly build portfolios based on a client's goals. Now, I'll tell you a funny little story. I was in the passenger seat with my son. I have 4 kids. My youngest is 17, and he was driving. It's actually rare when you as a parent are in the front seat as the passenger. And I was heading out for a trip for work, and I had to go give a presentation. I said, "Hey, I'm going to be gone for a couple of days." And he said, "Where are you going?" And I told him, and I told him I had to give a presentation. He asked me, Andy, what my presentation was about. And I just said at a high level, it's about goals-based investing. And there was silence for a little bit. And I thought he was uninterested, which not surprising for a 17-year-old. But he then asked me, he goes, and he said a quite interesting observation. He said, "Isn't all investing goals-based?" And I thought about it for a second, and I go, "Oh, you would think, but it's actually not." And I think we just exemplified that through the early dialogue around risk tolerance. Nowhere in the risk tolerance questionnaire that drives asset allocation does it actually ask you what your goals are. So number one is we want to incorporate the underlying goals of the client. Number two, we want to build much more robust, comprehensive risk management. Again, I just described this. The risk to the asset owner is not having the wealth, the money, the dollars they need when they need it over the course of their financial journey. Number three is, unlike the static just rebalancing back to the original weight that gets driven by risk tolerance, we want to have a very dynamic and adaptive approach, meaning our lives are dynamic. Our goals change, things happen, our cash flows change, we inherit money, we have medical conditions. So we want to be able to account for changes in our lives and our financial plan and changes in market conditions such that in real time, with the touch of a button, you can make the plan and the portfolio be in sync at all stages of your financial journey. And number three, and we see this very often, is that when we move to a goals-based framework, clients are just far more engaged. They have more trust and more confidence in the advice that you as advisors deliver. And I'm going to play a secondary theme on that trust and confidence. What we actually hear, Andy, as well from advisors that work with us is they, as the advisors, have more confidence in the recommendations they make because it's rooted in all of the client inputs, very advanced optimization that allows for robust output and true goals-based portfolio recommendations.
Yeah, let me just jump in there on that last point about the advisor confidence, because it's such a crucial point. Over the years that we've been working with these advisors, we've really worked with a very wide range. And the most common feedback across that broad range of advisors is the increased confidence that they have by following this process. We think the reason for that is because they, by going through this process of tying the client's goals and objectives, incorporating market conditions, and then understanding the relationship between the client's goals and objectives, what they believe about the markets, and seeing that reflected in the portfolios. It's that deepened understanding that gives them that increased confidence And that conundrum that we talked about before, about this disconnect between the asset allocation, the portfolio, the key determinant of the portfolio, and the plan, like that disconnect is gone because now we've connected what they're doing on the planning side with what they're doing on the portfolio side. They understand that, and then they can communicate that very easily and efficiently and effectively because they're not speaking in finance speak. They're speaking in natural language. They're having a conversation with the client. What do you need and when do you need it?
Excellent. Thanks, Martin. So to set the stage a little bit more before the demo, just NEBO in a nutshell, or how we think about the investment policy process, or just client kind of intake of that information of their needs, wants, wishes. This is a jump ball. The next two slides, Adam, Martin, whoever wants to take investment policy process and just what we do in a nutshell, I'm just going to throw it up there, and whoever wants to take it.
Well, I'll take a first stab, and then Adam, you can. I'll hand it off to you.
All right, let's go.
The key point here, I won't do the details. I'll let Adam do the details. I think the key point that I would want to make about this is that everything in NEBO is rooted in standard principles, common sense principles about what makes sense and what works. So we have yet to meet a person who does not agree that a sensible definition of risk is that you don't have the money you need when you need it. Everybody agrees on that. And we've really built NEBO around that concept. To take it a step further from an operational standpoint, we're then building the inputs around standard investment policy process. So all of these inputs, if you read the CFA curriculum and you read what they say about the inputs to an investment policy, you'll see them here and you'll see them reflected in our system.
So taking that, Martin, let's expand a little bit. So the NEBO wealth process starts with the essential elements of what we call the client's investment policy. Those are the things that you would expect, their goals and objectives. We want to understand the time horizon of those various goals, what liquidity needs they may have. Notice that risk tolerance is part of it. So it's part of the process. We don't throw it out. We're going to show you how we use risk tolerance in a couple of different capacities within our portfolio construction process. We want to incorporate cash flows. I'm going to make a note around cash flows here. Many of you that are dialing in and watching us today are astute financial planners. You do financial planning for clients. You might use some of these popular financial planning tools. We believe NEBO Wealth is going to allow you to enhance the financial planning that you're already doing. If you have that detailed cash flow table from any of those tools, we would want to incorporate that into the NEBO process. It allows us to be more robust and refined in the client's cash flows into the optimization. And of course, we want to understand their current assets and any legacy goals that they may have. Now, from those inputs, what we then do is we first calculate what the minimum required return is for that client to make their plan work. From that minimum return, we then project forward what the minimum wealth target would have to be over the course of their time horizon. I'm going to stress that again. It's the minimum wealth target. And then from that, using this advanced wealth optimization, we're able to construct the optimal portfolio that minimizes the risk that the client's wealth, their account value, their dollars, if you will, falls short of that target or falls into what is highlighted here as the red zone. And what I think makes our process unique is not just the wealth optimization, but the fact that that portfolio that we construct is completely open architecture. We can build that portfolio using your investment philosophy, your identity, if you will, as a firm, and can be comprised of any asset class from public markets, alternative markets, and even private markets. And it's open architecture in its implementation as well.
Thanks, guys. And just as we're doing this, as we're putting clients through this process, just the importance of being dynamic, forward looking, return projections, current market valuations. Are we able to incorporate that in the wealth optimization?
Yeah, so we spoke earlier about this idea that there are two primary inputs into the portfolio construction process. There's information about the asset owner, information about the client, their goals, objectives, time horizon, et cetera. And then there's information about the markets. And we, in our experience with working with financial advisors, we can really sort of divide them into two categories. There's a cohort of advisors that are not comfortable making capital market assumptions that are time varying at sort of the asset class level. What they do is they typically will use historical averages, then they will invest in underlying managers, and those managers they're relying on to make the decisions about how to vary exposures over time to account for current market conditions. And NEBO can handle that with no problem at all. So there's another cohort of advisors that we interact with that are valuation sensitive, and NEBO allows them to adjust the degree of valuation sensitivity that reflects their investment philosophy. So when equities are expensive relative to other asset classes, they will own fewer of those, and they can reflect their views on equities or any other asset class directly in NEBO. So it's fully open architecture in that sense. And we've built NEBO to be flexible so that it can, the advisors and the advisory firms can express their investment philosophy.
Thanks, Martin. I've seen a couple people join within the last couple minutes, and thank you for joining us. Just to kind of level set where we are on the presentation, we're going to get to the demo soon. Adam, if you can cue that up behind the scenes. I did have another question for you, though, just in the spirit of current market valuations. I've heard you talk about the concept of going beyond rebalancing to what we call reoptimizing. Maybe you can just talk about that a little bit.
Certainly. And for those that are just joining us, you've missed the lovely Boston sunset. I just turned my head around the back and it's almost pitch dark here. So we went from lovely orange glowing skies to darkness here. Yeah, this is actually a really, really important concept. And it's actually, I think, a really important part of goals-based investing, which is something we talked about earlier. Our lives are dynamic. Market conditions are always changing. And so let's think about it in the lens of what is traditionally done, which is we take the risk tolerance questionnaire. It maps us to a stock bond mix, and we're told to rebalance on a regular basis, whether that be quarterly, semi-annually, or annually. And the reality is, like, our assets change in value, our goals change, and market conditions change. And so part of goals-based investing through our framework is this concept of moving beyond just rebalancing and incorporating reoptimization into the mix. And what that does, Andy, is it allows us or advisors through our tools with the touch of a button is to make sure that that client's financial plan through the investment policy, the things we just talked about, their cash flows, their time horizon, things of that nature, is in alignment with the optimal portfolio. And that optimal portfolio can adjust based on market conditions. So what we've simply plotted here is a hypothetical 60-year-old investor who wants to retire in 5 years with a longevity of 95. We've given various characteristics to them through the financial plan. And this is just a snapshot of what their portfolio might have looked like at the start of every one of those scenarios. And notice that the weighting to equity changes depending on where you're in the cycle. The array of asset classes that we might want exposure to based on valuations changes over there. So we would argue that a dynamic and adaptive approach is part of a goals-based investment platform. And the way that we deliver that is through this framework that we call reoptimization. Why rebalance when you can reoptimize, Andy, as we like to say?
I love it. I'm kind of looking at the stock bond, liquid alts, real asset mixes, and they kind of remind me a little bit of model portfolios. And I want to get to the goals-based playground, so we want to go there fast. But maybe, Adam, I've seen you talk at conferences about this concept we call model selector. Maybe we can just skip ahead there so you can just give a little bit of a teaser of something that we think is really good that we've built out.
And so what we're getting into now, Andy, is the implementation of how do we actually implement a truly goals-based investment framework across, lots and lots of clients. So with the tools of Nebo, you have the ability in a few moments to load the client information in, hit a button, and get that customized, bespoke portfolio directly for the individual client. So theoretically, every client could have their own customized model portfolio. Now, I would argue that the industry is moving in that direction, but that feels a little overwhelming at first for some firms, and I understand why. And so what we've built into our capabilities is what we call a goals-based model selection tool. And that in essence allows us to do a couple of different things. You might have a series of model portfolios that you currently use, from conservative to aggressive. So what we're able to do is take, let's say, Mr. and Mrs. Jones, we can take all their inputs, we can run through that wealth optimization, and the output of Nebo could be, what is the optimal model of the array of choices that you may have in your current lineup? That lineup of model series, Andy, could be a third-party strategist. It could be a home office model. It could be choices within a retirement plan. So there's lots of flexibility with using the tool. And again, the open architecture nature of how we have built this business allows the flexibility to customize the goals-based framework to the way that you want to think about implementing, whether that's custom at the individual client level or through this model selection capability.
Thank you. So for the group, I love when these are interactive. I realized the Q&A box wasn't loaded when this started. So if anybody wants to refresh their browser, I've been told it's only a second or two, and you should see the Q&A box. If you wanted to ask any questions, comments, feedback, I'm just going to wait 2 seconds and pause in case anybody wanted to refresh and make this more interactive. Great. So, Adam,
Yes.
Are we ready to show what we call Basecamp to our friends in the audience?
We can. So let me do this. I'm going to share my screen. Let's see if I can do this. Okay, hold on. I'm going to just share my whole screen here, Andy, because I've got a bunch of different ones I want to show. Window. No, we're getting there.
As you're pulling it up, for anybody who refreshed the Q&A box, we're collecting any sort of fun goals or scenarios as we're doing our wealth optimization for the clients we have in the system, whether it's you want to buy a horse, saving up for a wedding, you want to buy a vacation house in a place that you grew up with your family, have really good memories, whatever that may be, feel free to throw it in there, and we could include our favorite ones into the actual optimization.
All right, Andy, I've shared my screen. Can you see the Nebo Wealth Basecamp?
We can, yep.
Okay, so let's use like a really simple example here and show you how easy it is to build custom portfolios, goals driven for each client. What we have here is a 60-year-old client that we've loaded into the system. Their retirement age, they've chosen here as 65. We've set 95 as a longevity number, although all of these are customizable. So through those 3 questions, we've captured the first essential element of, again, what we would call the investment policy process, and that is their time horizon. Current assets for this particular client, investable, we've put in $3.1 million. We then want to move into cash flows. Now here we can do a couple of different things, Andy. So for those of you that are financial planning oriented, that use some of the financial planning tools, we can take the detailed cash flow table from an eMoney, a Money Guide Pro, a Right Capital, many others, and we can upload those directly into Nebo. So we can take those personalized cash flows at the individual client level and allow that to drive part of the optimization process. Now, if you don't have the full financial plan, or let's be honest, sometimes clients don't want to spend the time or dig up all the paperwork to give you all the information, we're going to show you how you use our fast track tool, in essence, Planning Light, to feed the inputs that we need. And so what we think about in cash flows is that we can attack this in a couple of different ways. First, we want to understand how much are you saving pre-retirement? Give us an estimate of your annualized savings pre-retirement. Here I put $40,000 in. How much do you need to withdraw net in retirement? Here I put $180,000 in. So these start to build out of our cash flows. We can then move on and incorporate direct investment goals into the tool. And here we can just literally hit the plus sign, add different goals. So I've preloaded a few here just for speed and efficiency. We've got college costs. We've got college costs for Emma. As with 4 kids, one of my daughter's name is Emma, so I use that there. She's going to college for 4 years with a certain dollar figure. We may want to buy a vacation house, Palm Springs. We've got folks for all over the country. We even have somebody on the line from Sydney, Australia. So for him, I might put Noosa up on the northern side of Australia. But we can just load the different goals in here. Now, look what we're doing. We're incorporating goals, time horizon, dollar figures. We're, in essence, building a cash flow table. We separate out legacy separately. So here I've added a legacy goal, leave money to the kids at $1 million. But these are going to be very customized to individual clients. From the investment goals, Andy, we move into risk assessment. Now, again, we incorporate risk assessment. It's an important component, but let me explain how we go about doing that. The question that we start with is, what is your maximum loss tolerance, or how much could you tolerate in a bad bear market? So if someone were to say to us, I could tolerate a 40% decline, what we do is we use that as either a maximum stock constraint in our portfolio construction process or a maximum portfolio volatility. Now, if somebody says I can lose 40%, how do we know how accurate that is? Well, we've added in a consistency questionnaire to check the consistency of that response. We've built this, Andy, off the CFA curriculum, which has 6 essential elements of risk. I'm just going to simply answer the center or middle response for each one of these just to show you. So here somebody would go through, or you with the client, you would answer those various questions in here. And that's going to give us a framework to see if that number is actually consistent or not. Okay. From there, we can move on into the investment selection tab. I'm going to show you that right here, where a client can select, or you with them, what types of asset classes might you want to incorporate into the portfolio design. So here, let's just use stocks. I've got long-term bonds. Now notice in stocks, I have different sub-asset classes. In this example, we've incorporated large US, small and mid-US, international, emerging market. And then again, we can assign tickers here into the implementation choices. Those can be yours. It can be ETFs, mutual funds, individual securities, separate accounts, completely open architecture. So you would select the asset classes that you might want to incorporate in the portfolio design. Notice down here, we can also incorporate things like private equity, private credit, real estate, even ownership in a business. And maybe we'll talk about that in a moment. But from that, again,
Adam, can I just jump in for 1 second? Can you just go back one to the investment selection? I just want to point out to people that on the equities, for example, the mixture of sub-asset classes, what is listed in kind of that middle table, you can tailor that and customize that to your advisory firm's investment framework and investment philosophy. So it's not limited to those 4 sub-asset classes that you're looking at there.
Yeah, that's a really good point, Martin. So the framework for how we work with firms is we literally signed a new firm up today, and the first thing we do is get an understanding of your investment philosophy, how you think about building portfolios, What broad asset classes do you like to incorporate? What sub asset classes do you like to incorporate? How do you think about implementation? And we build and mold the Nebo platform and our tools to your firm. So every firm's version of Nebo is completely unique, bespoke to them. So really, really good point, Martin. Once we have this investment selection chosen here, we can move into the portfolio design piece. Now, this is what Andy likes to call the playground, and I think it's aptly named because the behavioral coaching and the trade-off associations that you have to have conversations with clients are really, really important. So let me just kind of orient you as to what we're showing here. So for this particular case study, we have a primary withdrawal goal. Remember, we said $180,000 annually. What that means is that for that particular goal, the client would need to generate, or the portfolio would need to generate, a minimum of 2.5% real. That's net of inflation, investment-related taxes, and any advisory fee that you may want to incorporate it. So that's the minimum return for that particular essential goal. Now notice we have the other goals that we layered in here. We've got the college costs, we've got the vacation house, I put wedding, classic car, these can be lots of different things. But as I click and I incorporate these various different goals, I've now added the legacy in. Notice that the minimum return now starts to go up and up and up, and it calculates what is required. What we then also do is we take that return target and we plot here. You see this black line? This is the minimum wealth target that the client needs to have over the course of their time horizon in here. So we can uncheck different goals. Some might be aspirational. And notice as I uncheck this, the target return can change. I'm going to also draw your attention right here to the feasibility table. See this 5.3%? Again, remember, that's net of inflation. This is also driven by the risk assessment that we talked about. So if we were to change the risk assessment here, where the max loss was around 25%, that's going to shift our total constraint on stocks. And notice when I come back into my portfolio design here for a second, it's going to adjust accordingly. Let me do it here, minus 25. I go into my portfolio design. Yep, I might have to refresh because I was idle for some time while we were talking before.
Adam, while you refresh, it's a good reminder. There's a couple other folks who just joined us in the last couple minutes. Thank you for joining us. Great to have you. If you wanted to ask any questions, just refresh your browser. It'll take a second or two, and you can put some comments in there. Thank you.
Okay. So we, because we have client information in here, when we sit idle, it automatically times out for the security purposes, which is always a good feature. Martin, it probably meant you and I were talking too much at the beginning. So, but notice when I change my risk assessment in here, I were to, let's say, drop it, it's going to automatically pull through and change our feasibility return in here. And so what we have within Nebo is we have a goals-based framework that we can now run optimization against. We have our goals, we have our minimum return on the essential goal, we have a maximum feasible return when it comes to the risk assessment, we have the target for the client, we've projected and built out the wealth path minimum that they would need over their time horizon. And what Nebo has just done here is run, and I don't want to get too geeky, but it's run multi-period optimization. And what that means is we account for the 5 years pre-retirement, 5 years, 4 years, 3, 2, 1, and then we have a 30-year retirement window, and we account for year 30, 29, 28, and we run through all of those multi-periods. And what you see here is the optimal mix of the asset classes that we had selected, which is stocks, long-term bonds, and liquid alternatives like a multi-strategy. And this pie chart, this portfolio allocation right here is the optimal mix given today's market environment and the forward-looking return assumptions for all of the underlying sub-asset classes that roll up into these three categories. This is the optimal mix to minimize the likelihood that the client's wealth, their dollars, their account value, if you will, falls short of target or falls into that red zone. And that at the cornerstone, Andy, is wealth-based optimization, taking the goals, the investment policy of the client, using this advanced wealth optimization and aligning the optimal portfolio from the array of asset classes that you want to incorporate with all of the underlying sub-asset classes into a portfolio mix.
Thanks, Adam. That was a really good preview. We're at about 10 minutes left in the session. We have almost everybody still on the line, so thank you. Before you go on to the end, Adam, I was hoping within this playground, in the spirit of enhancing the client experience, when we were at Schwab Impact, I listened to Michael Kitsis. I was sitting up front taking notes. Bottom line was from his session was the best of advisory firms are going to be focused on the client experience in the future. And something like this, where you just have an iPad or you open up your laptop and you go over these goals in real time with clients, you can have really, really good, meaningful conversations. And a couple of folks put in the question box some goals that I'd like to put in there. So as promised, Adam, if you wouldn't mind.
Oh, we want to change the goals? Okay, let's go back.
Yeah.
All right, here, let's do that. Let's go to investment goals. All right.
Great. So what I was seeing on the screen was, given the current goals and what is feasible for them, they could actually probably spend a little bit more or maybe do a stretch goal and still deliver on it based on what I've seen. So someone put in here, I actually had to Google search it, a Cirrus SR-22, which is a single engine airplane. July 2026, they're going to put 20% down, which is an $800,000 cash flow. So if someone really wanted to get into that, buy an airplane. Someone else chimed in, our friend from New Hampshire, that they probably have to get permanent life insurance in place before purchasing that airplane, but we don't need to model that. Let's just put the plane and see what happens.
All right, so I didn't get the specificity of the model number. So in my remedial world, I just put plane. In this case study here, we'll put in, let's make the vacation house like $1 million or so. I'm going to put NUSA for our good friend out there. We're going to have a mortgage on it. Let's say the mortgage is, I don't know, $50,000 or so a year. We've got the plane. We've got to leave money to kids. And this is a 50-year-old. If they're buying a $1 million house and an $800,000 plane, I'm going to assume they're starting with a little bit more money here. So let's give them 3.8, and we're gonna reset the framework here of this particular client goals. All right. So we switched to a 50-year-old. We don't know, based on Andy what you told us, where it should be. We've got their time horizon. We've got their current assets. We've got some cash flows in here. Let's bump them up here. How much do they want to withdraw per year, Andy?
I don't know. What's a normal spending? Is it 4%? Is that a
There's
rule
no
of thumb?
such thing as normal. Everyone is different. That's why you need tools like Nebo. Everyone is different. I put 240. That's probably high. Let's put 180. Okay, we'll put 180. We have the various goals. We have the risk assessment. Let's say 35%. We've got the questionnaire. We'll skip that just in the interest of time. We can go into our investment selection here and portfolio design. Yeah, I might have to. This one was idle too. I'm going to refresh it. Martin, we were definitely talking too long in the early stage.
For sure.
I think all the code was just transfixed by that beautiful sunset in your background, Adam. It kind of
maybe while that's refreshing, I could just address a couple of questions I saw. There was one question on, can you adjust the target return, say above the minimum required return? And the answer is yes. That's what we call the possibilities based approach. So NEBO's philosophically agnostic between a goals-based approach and sort of possibilities-based, but you can absolutely set a target rate of return and see how situations change when you do that. There was another really good question about hyper-personalization and how you do that. And I think NEBO can give you personalized model portfolios at the asset class and sub-asset class level, and that can be mixed in with personalization at the implementation level. So from our perspective, there's been an enormous amount of effort put into personalization at the implementation level, be that custom indexing or tax loss harvesting. What we think is lacking is personalization at the asset allocation and sort of sub-asset class level. And that's where NEBO comes in. And so it's very complementary to those other sources of hyper-personalization. And the reason why you can do that at scale is because you can construct building blocks at the asset class and sub-asset class level that can be reused across a wide array of clients, but each client gets their own custom mix of those.
All right, so Martin, I was playing while you were talking, and so you probably saw me playing around. But that's the cool thing about NEBO is you can like stress test different client environments. So here's what we have, Andy. We've got that 50-year-old. They're going to retire at 64. We have 92 as the longevity. You saw me bump the wealth up to 3.8. Their primary withdrawal is 180,000. That's a 0.8% real return minimum. So that sets the minimum. The maximum feasible was driven off the risk assessment, and we have the vacation house here. We have the mortgage on it. We have that fancy plane. I can't remember the type of plane, but that shows that I don't know a lot about planes. Notice as we incorporate these goals, the required return goes up, and we want to leave some money to charity at the end. I'm going to do this. I'm going to change the charity amount here to something like $2 million. Let's say that was the original amount going in. Notice what's happening is our target return changes. This target wealth path just changed dramatically there. Notice the ending value way up here. It's incorporating the goal directly into it. If I were to take that amount off, notice that my wealth path changes, my required return changes, and so we can optimize around these various things, accounting for the various goals. This is the most important part of goals-based investing. Accounting for the goals, accounting for the cash flows, accounting for the required return needed to achieve those goals, accounting for the risk assessment in terms of constraints within the optimization process so that we can build a forward-looking minimum wealth target. Again, risk to the asset owner is not having what you need, the wealth you need when you need it, which we've plotted here, and then running this advanced optimization to say, for this particular client, given their circumstances, this is the optimal mix of stocks, long-term bonds, and a form of liquid alternatives. And then again, under stocks, we have all of the underlying sub-asset classes that creates the target portfolio. And then we can run all the viability testing on it and account for things like probability of success, median wealth, potential shortfall, and the like. So this is a direct connection with client goals, optimal portfolio, current market conditions, forward-looking expected returns, and building a target for that client, a customized client portfolio.
Excellent. Adam, that's great. Just 1 minute warning. We're about to hit the top of the hour. We've gotten over 25 questions, which is delightful. Maybe just one last thing. Could you just talk about the connection between what we're doing here in the playground and the actual trading or implementation of portfolios? And for anyone else, if you have to run within the next minute, thanks for joining. If you want to learn more about us, nebowealth.com. Reach out to us directly. We'll be sending you a replay since you've joined. Follow us on LinkedIn. But Adam, maybe if you could just do portfolio implementation for a minute or two.
Yeah, that's a great way to close, Andy. So thank you. So what you see here is we have the fully optimized portfolio at the broad asset class level. Here we've just gotten stocks, bonds, and alternatives. What we didn't get into today at all is business ownership, private equity, private credit. We can accommodate all of those. And if you're interested in that, I'd highly recommend going to nebowealth.com. Just book a demo and we'll kind of walk you through. We'll do some case studies live with you. But under the hood, if we look within equities, we've got large cap US, we've got some small and mid cap, we've got international, we've got emerging market. This is just a sample here for this demo. We've got tickers here that you can assign your implementation. So what you get left with is broad asset class, sub asset class, tickers, and weights. In essence, Andy, it's a target portfolio. And then we have this little export button here. And here you have a couple of different choices. You can export and upload that target portfolio to a rebalancing tool. We API into Orion Eclipse. We can upload into iRebow. You can take those and trade yourself. What we also offer for those of you that are trying to grow and scale is take those targets and direct those to a full outsourcing trading, rebalancing, billing, and reporting tools that we have integrated. So maybe the best way to end this, Andy, is for those of you that want to outsource the trading piece, grow and scale, what Nebo Wealth offers is what I would argue the very first completely open architecture, turnkey, goals-based portfolio construction process from client goals to the process that we just implemented with integrated trading, rebalancing, billing, and reporting. There's really nothing like it in the industry, and we'd love to sit down, learn more about your unique needs and goals and circumstances as a firm, and see if there's an opportunity for us to potentially partner together to help you deliver more enhanced goals-based portfolio management to the clients that you serve.
Excellent. Thanks, Adam, for wrapping up. I think it's amazing that over 90% of the audience is still here. The folks that dialed in before 4 p.m. Eastern time, special hat tip to you for joining. We've got almost 30 questions now, so we're going to have to triage it. We're going to follow up with every one of you one-on-one, whether it's email bullets, we can schedule time to chat with us. Thanks for joining, and appreciate you and wish you and your loved ones an amazing holiday season, Merry Christmas, Happy New Year, et cetera, et cetera. Thanks, everybody.